Dear friends, we had talked about the concept of time value of money in the previous lecture. Today, we are going to talk about cash flows and its connection with time value of money, or why we need to understand or why we need to study the concept of time value of money. It simply says value of money over a period of time. Right? To put it very concise, very brief, what's time value of money? Time value of money reflects value of money over a period of time. Now, what's value and what's worth, that's all has been discussed in the earlier lecture. Now, why to study time value of money? Time value of money is an integral part of FM. Hence, its study and relevance assumes critical significance. It's not an important concept, it's a critical concept in FM. The word that needs to be emphasized or being emphasized is critical, so to speak. Now, why critical? When do you call it as critical? When a certain part, when a certain component is an integral part, right? It's an integral part. Like, for example, in an automobile, apart from chassis, body, engine, all these things, the steering wheel is an integral part of an automobile, hence it assumes critical relevance in the study of automobiles. Similarly, time value of money, it being an integral part, if you remove time value of money from financial management, it's like a body without soul. The soul of financial management is time value of money. Now, why time value of money? Because it's an integral part and hence it assumes critical significance and relevance. And what is financial management? Financial management is a trade-off between risk and returns. Right? TVM, integral part of FM. FM is a trade-off between risk and return. This is how the combination is. So in essence, time value of money is related with risk and returns, and more importantly with respect to returns and risk. Now, what is risk we had studied? These are variations from the fixed target. Whatever you see the variations, like for example, what is the risk in investment? Risk in investment is either you are going to make the desired profits or you are going to lose your capital, right? That's principal amount. You may lose, that's the risk. Now, what is expected? Expected is that you are going to earn 10% rate of return. But to earn that 10% rate of return, you are carrying the risk that the investments go wrong or you may earn more than 10%. That's the risk you carry. That's variations. So TVM, integral part of FM. FM is connected with risk and returns, since TVM is connected with these two aspects. When what are returns? Returns comprise of profits and value. Profits in a business are for owners, value is for shareholders. Now, you do financial management so that you make profits for owners and increase the wealth value, right? Increase shareholders' wealth. Shareholders' wealth. So that the value of their investments, it goes up, right? Value of investments, it goes up. So, there's a trade-off between variations and profits. Now, how do you measure returns in business? How do you measure that? Now, measurement of returns are determined by, more importantly here the term that is important here in this case is cash flows. Now, what are cash flows? Cash flows are the amount of money that comes into business and goes out of the business due to business activities, right? Those are cash flows. Now, the value and frequency of cash flows reflects the financial soundness of the firm or business. See? Try to understand the relevance, right? You do business, you do financial management in business, and financial management comprises of trade-off between risk and return. Returns are measured or determined by cash flows, the indicator of whether there are proper returns or not, or whether there are returns also or not in the business, are determined by the quantum of cash flows. And cash flows, its frequency, that's the number of times the money is coming and going out, and the value reflects the financial soundness of the firm or business, etc. Right? Bigger picture. Time value of money is related with integral part of financial management. Financial management comprises of risk and return. Risk and return, risk, variations, returns, profits for owners, and value of investments going up for shareholders, thereby increasing their share wealth. And returns are measured or they are determined by cash flows being value of the amount of money that keeps coming into the business and goes out of the business for business purpose. Now, the value and frequency of these cash flows reflects the financial soundness of the firm. How? Let us try to understand what is cash flow. What exactly do you mean by cash flow? It's a net amount of cash and cash equivalents being transferred into and out of business. Money coming in and money going out. Coming into the business and going out from the business. Also, cash flow is the company's ability to create value for shareholders. This we have discussed. cash flow reflects the financial soundness of the firm. Financial soundness means the ability of the firm to generate profits, right? This is called as financial soundness. Now, cash flows within the company, it gives the company the ability to create value for shareholders. What is value? If you remember, value is worth when quantified. That we had discussed in our last lecture. Worth when quantified becomes value. So cash flows give company the ability to create value for shareholders, means it creates worth for shareholders. Now, cash flows also reflect the result of the activities associated with any business. If you look at any business, there are three prime important activities. These are the activities of business. They're categorized as operating, investing, and financing activities. Any business you look at, it falls under the purview of operating activities, investing activities, or financing activities. Now, operating activity is the main business activity. Why are we doing business? Right? So that we are able to produce goods or provide services. This is our main business activity. That is why we are doing business. So it falls under the purview of operating expenses. Now, what are investing activities? To carry out the operating activities, you invest money for purchases of capital assets and investments in other business centers. Now, what are the business centers? Business centers can be marketing, HR, IT, production and operations, right? These are business centers actually. So why are you investing? And what are the investing activities? Investing activities include purchases of capital assets and investments in other business centers. You purchase land, you purchase machinery, plant and machinery, right? Why? To produce. Why you are doing all this is to either produce goods or provide services. This is the investing activity. You do the activity so that your business operations are carried out smoothly. Now, how do you operate and how do you invest? How do you carry out both these activities falling under the purview of operating and investing? By financing. Now, how do you finance the activities? You finance the activities of business from the proceeds gained from issuing debt and equity. Proceeds, the money that you receive when you raise capital either through debt or equity. Also, financing includes payments made by the company for purchase of raw material to carry out business activities, right? To distribute goods. All these activities, you make payments for labor, wages, You provide salaries for employees, so on and so forth. So these are all financing activities. So cash flows result reflects the result of the activities associated with any business. To do operating, you might need to purchase raw material, you might need to purchase plant and machinery and all these things. For that, you need money. How do you raise money? Either through debt or shares. You get the money into the business, you put the money to productive use, right? And you invest the money, you generate profits and increase the shareholders' value or the wealth. And to do all these activities, what do you need? You need a study of financial management. Now, why study of cash flow? Quite interesting. Study of cash flow helps in assessing the quantum, timing, and uncertainty of cash flows. Right? Now, cash flow study helps in assessing the quantum, that is, how much money you require, helps in assessing and providing answer to the question, how much, right? That is, how much money is required, quantum, timing, when, uncertainty, from where. So, cash flow helps in assessing the quantum, how much of money is required, from where you are going to get it, when, and from uncertainty, from where you are going to get it, when you are going to get it, reflects the timing activity. So this gives you a brief understanding. You are aware that you are going to receive money either from operating activities, financing activities, or investing activities. You try to have a sense that, okay, after 2 months, I'm going to receive the money back from the customers to whom I have given my product or goods, right? So cash flows helps you in anticipation of the money that is being, or the revenues that are being generated by the business, either through operating, investing, or financing activities. So, how much money you're going to get, when you're going to get, and from where you're going to get. Uncertainty, both in and out of business. Cash flows, money coming in or going out. Study of cash flow reflects firms' liquidity, flexibility, and financial performance overall. Right? So, if there is a steady stream of cash flows, what does it reflect? It reflects liquidity, flexibility, and overall financial performance. You are assured that there is going to be steady liquidity. The liquidity position is going to be sound. And dear students, financial management per se is done to maintain the liquidity position of any given organization. Liquidity simply means the ability of the firm to convert its current assets into cash. That's what we call it as liquidity. Of course, money is not lying idle in the company. You don't say that, okay, any company on any given day has X amount of money lying idle. That is foolish or improper, unsound financial management. So what is financial management? Putting money to productive use, right? putting money to productive use, how to put the money, how to put the funds, not exactly money, how to put the funds to productive use. That is how you take care of in financial management. Now, study of cash flow reflects firm's liquidity, flexibility, financial performance overall. Now, let us try to understand what do you mean by liquidity. Increasing liquidity, right? This increasing liquidity, it's rising. And increasing liquidity means steady stream of cash flows. Steady stream of cash flows enables to cover obligations. Obligations, what are obligations? Obligations are with respect to payments. Payments to whom? Payments to the vendors, payments to the employees, payments to utilities, all these things. Now, if the liquidity is constantly rising, increasing, it enables to cover obligations. Whatever liabilities are there, they can be met easily if there is constant and consistent increase in liquidity. That liquidity which is lying idle can be reinvested in the business. That is, either you can buy raw materials at lesser cost, or you might give incentives to sales and distribution people to promote more, to generate more revenues, or you might employ that money in some other investment activities apart from your core business. Increased liquidity also helps in returning money to shareholders. You can pay expenses, etc. Now, flexibility. Flexibility is represented by two arrows in opposite directions. That means any arrow can move in any direction. That's what we call it as flexibility. Now, if any given business has flexibility because of increased liquidity, it leads to profitable investments in future. Right? You can invest wherever you want, whenever you want, how much soever you want. That is what you're having: ample liquidity, ample funds available with you because of steady stream of cash flows. Also, financial performance is on the rise always. So if financial performance, how do you measure that? Steady stream of cash flows leading to profits, leading to increased shareholders' wealth is what we call it as increasing financial performance. Now, what does it lead to? It helps the company to fare better, FARE, fare better in downturns. That is, downturns means recession times. By avoiding the cost of financial distress, you can anticipate the financial distress that is going to come into play at the later state and stage of economy. Right? You can anticipate better. And when you are in a position to anticipate better, you can face the consequences in the best possible manner. Right? So, from where does this ability come? This ability to anticipate the risk better, to anticipate the state and stage of economy better is because due to, if you remember this, what is that? Steady stream of cash flows. That is the reason, these are the reasons why we need to study cash flows. Briefly put, Time value of money measures the value of cash flows into the business. I told you why we are studying time value of money, and to understand time value of money, why we are studying cash flows. Right? Time value of money measures the value of cash flows into the business. Now, cash flows form the backbone of business, and time value of money determines the solidity, the functionality, and adaptability of the same. What do you mean by that? Just pay slight attention to this. We were talking about financial management, and in financial management, we are talking about time value of money. And why we are talking about time value of money? So that we can manage the funds better. Now, why do we manage funds better? So that we can reduce the risk and increase the returns. Now, to measure returns, you need to measure, if you want to measure returns, you need to have an understanding about cash flows. Now, what are cash flows? It's a steady stream of funds that are coming into the business and going out of the business. More steady cash flows give the impression that the financial soundness of the firm, or the financial ability of the firm to generate revenue, is sound in nature. And what are the indicators of sound cash flow? Liquidity, flexibility, and anticipation of overall financial performance. Finally, and briefly, time value of money measures the value of cash flows into the business. Not how much money is coming into the business or going out of the business, but the value of the money. When you say the value, means what? Whatever money is coming into the business, or whatever funds are being generated, or whatever the revenue that is being generated by the business, how productive is its utility? That is measured by time value of money. That is what we call it as value of cash flows. It's not the quantum itself. Say, for example, if you are thinking of, you might have sold goods on credit, say for 1 lakh rupees. Now, what is that? This, you are anticipating your cash flows value is to the extent of 1 lakh rupees. With this 1 lakh, you can either purchase 500 kg of raw material, you can pay to 50 employees, you can pay your utility bills. This is what the ability to do all these things is worth. And the revenue that you are expecting is measured in terms of value. So, this 1 lakh rupees worth is measured by time value of money. And cash flows they form the backbone of business, and time value of money determines the solidity of cash flows, the functionality of cash flows, and adaptability of cash flows. Solid means how robust is the cash flow, how sure you are of the cash flows. That is what we mean by solidity. Functionality, how can the funds that you are going to receive can be put to best productive use. And adaptability, apart from generating profits, apart from increasing the sales revenue, where else can you invest that money is what we understand by the adaptability of cash flows. Now, put it simply, or whatever we have tried to understand by cash flows. Now, why we are talking about cash flows is simply because the purpose of doing business generate sales revenues. And apart from that, you might also want to become the number one company in your category. Now, when you say sales revenues, that means sales revenues, in other words, it means steady cash flows. Now, if your business is doing better or not, if the business is in the right direction or not, is studied by understanding the cash flow statements. If the cash flows either more predominantly as the cash flow coming into the business, if it is steady, that means your business is sound. And you are also, if the money is going on a consistent basis outside for making payments, it also implies that your business is doing better. And when your business does better, that means your ability to make the business profitable the chances go up. If the chances of going that up is bright, then your business is in safe hands. Now, since you're talking about money being received consistently and constantly in future, so how much money you should receive accordingly is determined by time value of money. To keep it simple, what we have discussed so far is that we are talking about business being sound is determined by steady cash flows. Now, steady cash flows means, are you receiving the money that is owed to you? Supposing you might have sold goods on credit. If you are receiving consistent cash flows, say in first month, next 1,50,000 rupees in second month, 1,75,000 rupees in third month, again 1,00,000 rupees in fourth month. This is what is a steady stream of cash flows. Now, this steady stream of cash flows, its value is measured by time value of money. And that is the reason why we are studying time value of money, cash flows, right? These are quite interconnected. How much revenues you should generate within a certain time frame helps you in understanding the financial viability, the financial soundness of the business, investing and financing activities. That's all for now. Take care.